Markets began 2025 on a fairly strong footing after equities hit record highs last year. But with the threat of U.S. tariffs coming as soon as next week, should investors be expecting a bumpy ride ahead? Joining us now to discuss is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, always great to have you here, particularly when we're just days away from what could be some pretty big changes out there.
Okay, Greg, great to be here.
Let's talk about what's on the horizon. We're going to go home for the weekend. We're going to relax, hopefully have some fun. And then on Monday, we're going to have some news to deal with, perhaps.
I think some of the context of what I think I want us to kind of go through today is we have the inauguration on Monday, and the amount of noise around this. I don't know if I can recall in my lifetime the noise around an inauguration quite like this, and so how much I want to kind of bring some of it back into what's going on in the economy and what's going on in the world, and then how that's going to kind of impact that. And we are in the middle of a pretty remarkable journey. And if when we were sitting here last year, we were saying market expectations are that we're going to see a recession, and that inflation was quite a dire topic, and people were worried about unemployment starting to increase, and it might be a more difficult year for equity markets. And of course, we know two back-to-back 20-plus years, and then now you're kind of entering this year of going, well, boy, with Trump and correction, and like there are lots of things to be worried about. And I think that the starting point of this is, I think for us to start looking at it is that in the middle of all this noise, and noise that we can dig into that can be quite concerning, is that the economy south of the border is gone from this last year worried that, we're late stage and that there could be a recession. We were in the camp that we thought, it's late stage, but we were in the soft landing camp, and there were many others too. I don't want to, and that if you think about it, the last time, maybe not, let's say 2 times ago when I was here, I was saying look, we're kind of in this early stage now. And another constant theme that we've had is talking about the idea where I've said, that the rate of change, markets used to trade going through an economic cycle, like some kinds could take 3 to 5 years. The markets trade on a daily basis now based on algorithms. And these algorithms drive us through perceived market cycles a lot quicker, right? If you think, there's a discount mechanism, you go, how I'm going to want to price this out? And I think the really good starting point for our discussion today is going that almost everything how I'm going to frame this are the risks that are out there, but to say that remarkably from January to here, we actually have a market that's trading like it is in a mid-stage economy. And so if you have a market that's trading in a mid-cycle economy, that's a pretty good economy you're in the middle of, and it helps to really start to explain away a lot of the things that have happened and where we think you need to allocate capital from here, and how you're going to and then how do you manage the risks that are going to happen with this inauguration, and what could happen in the first couple of weeks. And I think that's a great starting point for us.
All right,
today,
so let's start digging in. If that's where we're starting, you're talking about risk, you're talking about navigating the waters for the next little while. What are we thinking?
Well, so in the middle of all of that, if you looked at that and said, okay, well, if you were mid-stage, and if you looked at it and said, we've made that journey in 12 months, in this, and it's a journey in market terms, maybe not where the economy is, but the market terms of expecting that. And so if you look at that and you go, well, one of the things I said to you last time on, I was here, because we were talking about the year ahead, as I said, well, that I think there'll be a correction. And guys in my world are like, oh boy, these are words that are never supposed to leave your lips, right? But I don't work that way, and so I think the first starting point is to say that market corrections are a really healthy thing. They're required to kind of work some steam out of the, and And this one's kind of interesting in that we kind of know that we have this new administration coming in. We know it's going to come with a whole lot of noise. And so what I wanted to start, framing here a little bit is to say, okay, if you expect that there's going to be a correction, then how does that start to look like? So first and foremost, I brought a chart along that I want us to look at about saying that's just looking at, how long it's been. And so basically you can go back over the last 10 years. Every year or so, you have a 10% market correction. You can almost like put it on your calendar, right?
Yeah.
And all we're showing here is pretty consistently, here's market corrections. Here's what the returns are after 30 days, 90 days, 180 days. And people are living in a lot of fear of there could be a correction. And what I want to put a little bit of the fears is that if you're in a mid-stage economy that's pretty healthy and you ended up having a correction, that you're probably the 90 and 100 days and the 1 year following that, you're probably in a pretty good position, even though you had that. We haven't had this kind of drawdown for a couple years. And so, it just a reversion to a mean and expectation of that. I think this is a really great starting point of thinking of being an equity investor. Now I can see we popped up the next chart and we're going to get a bunch here, but there's a reason. And the reason is the connection point. I want to look at this. Ultimately, when you're looking at the biggest fear when it comes to Trump, is Trump administration equals more tariffs. And the fear isn't the tariff. The fear is there going to be a recession? Tariffs will lead to, the fear is tariffs increase the likelihood of recession. There'll be a recession. What will happen? So I said, okay, let's just look at that. So on the far left-hand side, we looked at, here's the S&P 500 and the TSX, looking at a recession in 1980, looking at a recession in 1981 and 1990, which just shows you how long it's been since we've had a, gloves out, all out, off and brawl recession. And then I said, well, look, why don't we throw in the other crises that we've had since then as well? The tech bubble, the great financial crisis, the pandemic. And said, and if we look at that, if we could go back, because we're in the results of it, is that if we go back, you can see what the drawdowns are. And then we look at it, and what we're looking at here now is saying, okay, here's the returns on this in the next 2 years after the equity market bottoms out. And I think that the message I'm trying to kind of hit home here with is that that when you try to put this in context of what the pain you're going to feel is, we kind of have a gauge of that. Your average drawdown in all these crises going back are 15% drawdown for the TSX or for the S&P, 18% for the TSX. The upsides are really, really pretty extraordinary if you look at it. And then what I want investors to kind of think about is that most investors don't have all their investments where they push it all in and say it's all going to be the S&P 500, it's all in the TSX. Most investors have a portfolio where they run some diversification. So think about it in this way. You have a 15% drawdown on average from all the ugliest drawdowns, including 3 recessions going back to 1980. You have in the TSX, it's 18%. Let's just throw in, you had some bonds in there. You had a treasury bill in there. You did a little bit of diversification. You can probably cut that drawdown somewhere by half. So all of a sudden you're saying, okay, so my drawdown is somewhere between 5% and an 8%. In a world where I'm worried about Trump tariffs, geopolitical uncertainty, all of that. But all of those, there's a lot of noise and it makes a lot of sense, the fears around it. The flip side is that there's a lot of ugly things that have happened in the past. And if I said to you, like, look, if you're running a diversified portfolio and your ranges of losses in that are very similar type of occasions in the past, I think it takes some of the heat off of this a little bit, right? And that's my starting point of today is to say 2 things. Is one, we are in a market that is trading like it's mid-stage. If we see a correction, this is a market that's due for a correction.
And you said that these are healthy.
And that they're healthy. And the flip side is that then if you stop just looking at the enormous amount of fear and noise we're getting, pull yourself away from YouTube for a minute and Instagram, and just look at it and go, okay, if all those things were true and I was preparing and running a diversified portfolio, I even know what my downsides are. And the flip side of this is, what does it look like over the next 30 and 60, 90 and 180 days? It looks pretty good.